What if I could show you how to become 34% wealthier than the average American, never have to worry about emergencies, unexpected expenses, all while putting you on track to build twice the income in retirement by capturing the money that normally just passes right through your hands? In this video, I'm going to show you how to do all that and be in control of your financial life through a strategy we call Perpetual Wealth Financing. My name is Luke Kibler. I run Vantage Insurance Solutions, and our mission is to educate people on the honest truth about financial planning in today's economic environment. Now, before we get into all the details of what Perpetual Wealth Financing is, we're going to talk about two of the four cornerstones. And by the way, you can reference the previous video about the four cornerstones if you want to learn more about that. If you haven't seen that video yet, I highly recommend go and watch the four cornerstones before watching this, because that'll really help you understand the context here. But let's go ahead and talk about two of the four cornerstones that Perpetual Wealth Financing really applies to and solves some of the biggest financial problems that we have. Cornerstones 2 and 3 are emergency funds and short-term savings. Things like vacations, home upgrades, cars, all of these things you see on the list here. These two liquid buckets of money that are really essential to having a stable, sound financial plan. Now, there's typically these two characteristics that most people think about their emergency funds having. They want their money to be safe, and they want their money to be liquid. In other words, it's not tied up, it doesn't have penalties, you can get to it whenever you need it. And so for most people, that means it's either in a bank account or under a mattress somewhere. But there's a problem with that. When your money is in those two places that most people keep their emergency funds or short-term savings, your money is losing value. I'm sure you've heard of the little thing called inflation, where every year, typically, by a changing percentage, your money is going down in value because of the increased cost of goods and services due to inflation. So your money, it's critical that your money is productive. And so there's two more characteristics that we like to add to what is necessary for these two cornerstone buckets of money. We want your money not only to be safe and liquid, we want it to be productive. We want it to be earning interest, we want it to be growing, working for you. And if it's productive, we'd also like it to be tax-free. The whole essence of Perpetual Wealth Financing is showing you a way to multiply and multitask your dollars in a tax-free environment. This Perpetual Wealth Financing strategy is a way to do something that copies what big banks and wealthy people and companies have been doing for many decades. They just don't teach it to you and me. And you might be asking yourself, well, why is that? Why haven't I heard of these things before? Well, the reality is it doesn't serve the bank, who tends to like to be in the center of your financial life. They want to be the ones in profit and control. It doesn't serve them to teach you how to be in the center of profit and control of your financial life. But the essence of Perpetual Wealth Financing, the essence of the strategies we teach our clients, is to do exactly that. Just like you see on this screen, we want to put you in the center of your financial life, where both profit and control are in your hands, not someone else's. And so, of course, teaching you to do that isn't top priority when it comes to the financial institutions that practice these very strategies. So let's look at what Perpetual Wealth Financing is. What does it look like? All right, so as you can see on the screen here, you'll see this $0 line. The idea here is there's basically two ways to buy things. If you're going to go buy a car, pay for a vacation, the two ways you might pay for that are cash, or you might put it on a credit card, go into debt. So financing, as most people think of it. So cash and credit, the two ways typically to buy things. Now, the key shift in thinking you need to make here is to understand that both cash, spending your own money, or debt, spending someone else's money, they're both a form of financing in the sense that they both require payments, and they both also have an interest cost associated with them. And we're going to break that down so you can understand what that means. So on the debt side, it's pretty obvious, right? I think we all know when we owe money, we've got this negative account balance we've got to pay off, we've got payments, and we got to work our way back to that zero line. And we tend to get the fact there's payments involved, there's interest cost involved. Now, like we talked about in the four cornerstone video, I don't think most people realize the gravity of how much interest they're actually paying, but we get that it's there. And for many people, there's many of these going on simultaneously. The car loans, the credit cards, student loans, all of these things where we're making payments and we have interest cost. So that's the debt side. And if you want to go buy that car today, you get to go out and buy it, and then you start making payments to work your way back to that zero line. Now, on the cash side, it's the opposite. If you want to go buy a car today, what do you need to have first done for the past several years? If you're thinking pay yourself, you'd be right. And then when you go ahead and buy that car or pay for that home remodel, whatever it might be, what happens to your money? Down it goes, right back down towards that zero line. And so if you want to plan to buy the next car, the next vacation, what do you immediately need to begin doing? Paying yourself back, right? Making deposits into your account. So we tend to think of these payments to ourselves in a very different light than we think of payments to the bank or to someone else. So one of the biggest problems here and shifts that need to be made in our own minds in the way we think is that we need to put equal priority on paying ourselves in the same manner that we put towards paying others. You see, we would probably never think to walk into a bank or go to a car lot and take out a car loan with no intention of paying it back, right? You'd never do that. No responsible person would go and take out a loan with no intention of paying it back or no thought to whether they could. However, how often have you heard of someone perhaps that took their own money with no thought as to how they could pay it back? It happens all the time. We tend to treat our own wealth with very little respect, yet other people's money we treat with very high respect, and we would move heaven and earth to make that payment on time. So what if you treated your own money with that same level of commitment and respect, that you would never take from it without the same commitment to pay yourself back? How much wealthier do you think you'd be? Probably a lot. And the wealthy, that's one of the differences between the wealthy and the poor. The wealthy always pay themselves back. They put a high priority on paying themselves first. So we get that there's payments, right? On both sides of the line. If you have debts, you have to make payments. If you want to fill your savings account, you have to pay yourself, make payments to you. Well, the question is, who are you paying? Where's the interest cost on the cash side of the line? Most people, they don't really think, well, okay, I'm not paying interest on the cash side of the line, so how does that work? Well, that comes in the form of something we call lost opportunity cost. And like the name suggests, it's essentially the lost opportunity to earn interest on your money. Well, let's take a look at what that means. Let's say you had $50,000 in your account and it's productive, it's earning interest, and then you took $30,000 and you paid for that home remodel and that leaky roof, or bought a new car that you needed because yours was just done. Well, now what are you earning interest on? $20,000. So now you're only earning interest on $20,000. Well, lost opportunity cost means, well, what would that $30,000 have done for you if you hadn't spent it, if it wasn't gone? Well, $30,000 over 30 years at just 4% would earn an additional $70,000 approximately in earnings. In other words, it would have tripled, more than tripled in value at just 4%. So lost opportunity cost is all of that money that you could have earned if you hadn't spent the 30. So you're not just spending $1 today when you spend $1. You're spending everything that dollar could have turned into. So understanding this concept of lost opportunity cost should affect the way you spend your money. It should change your perspective on the value of your own wealth and your own money. And in doing so, it'll help you keep a lot more of the money you make. That's the idea. Now, typically, this is where the conversation ends. For most people, it's cash or credit. It's these two options for buying things. But what if there was a third way? What if there's a way you could have a bit of the best of both worlds? And there is. It's called perpetual wealth financing. Let me show you what happens when you practice this. You would build up your wealth just like you would in a savings account. You see now this blue line going up. You build up your perpetual wealth financing account. And then when you make your purchase, that $30,000 you plan to spend on whatever that essential might be, guess what? You're still earning interest on all $50,000. Not on the 20, on the 50. And then just like you'd make payments to the bank if you needed to pay the bank back on a loan you took, and just like you would make payments to your savings account to fill it back up if you emptied it, you're going to pay this perpetual wealth financing strategy back, but you get to keep all the lost opportunity costs at the same time. You get to kind of have your cake and eat it too. That's the idea of perpetual wealth financing, is using strategically designed financial products for financing your life in a profitable and tax-free way. So let's take a look at an example of cash versus credit and buying things. Let's assume you walked into the bank and here's your banker, you're sitting across from them and you're going, hey, I need to take $20,000 out of my account because I have this emergency. I got to pay for it. And the banker says this to you. How about this? I have an idea. You take that $20,000 and you put it in a savings account, and we're going to pay you 4% interest on that savings account. And because you did that, we're going to give you a loan for $20,000 and we're going to charge you 6%. So here's the magic question. Would you take that deal? Why don't we just look at the math and see what that shows us? So here's a loan calculator. You'll see the $20,000 loan amount that they lent you for 5 years at 6%. You'll see your payment amount, and on the right-hand side, notice total interest paid. $3,199.36. Keep that number in mind. Now let's go to a savings calculator. You've got that 20 grand that you put in that 4% savings account. What is it going to do for you? Well, over the same 5 years at 4%, on the right-hand side, you'll see the total interest earned, $4,333. Well, let's put these numbers side by side and ask the question again. All right, so If you keep your 20 grand and don't take it out, it's going to earn $4,333.06 for you over that 5 years. If you take the bank's money, the bank is going to charge you $3,199.36. So the obvious question here is, well, which is costing you more? If you take the bank's money, it costs you $3,200. If you take your own money, it's costing you $4,300 in lost opportunity cost. It would make all the sense in the world to take the bank's money and let your money continue to grow, to put the priority on paying yourself first, preserving your assets first. But again, if you're like most people, you might be scratching your head right now going, well, how is that possible? They're charging me 6 and paying me 4. How is it possible that I'm earning more interest than I'm being charged? Well, here's why. The idea of a decreasing expense versus a compounding gain. The magic of compound interest is when it gets to continue to compound and grow over a great length of time, that's where it does amazing things. Now that we know that this principle works, even if the bank is charging you 2% more than they're paying you, imagine you could have a relationship with a lending source that gave you guaranteed access to their money anytime you wanted, up to the value of your money on deposit, but they only charged you exactly the same as what they pay you. How much more profitable would that be? And that's the principle of perpetual financing. It gives you access to that kind of capital resource. So let's talk about what that means in having the best of both worlds. So essentially, in traditional debt, there's one main advantage here. You have the use of other people's money. You have leverage, you have that ability to free up your own money for perhaps other more profitable things. But there's some downsides. You'll see here on the cons list, you don't control the cash flow. In other words, if you take out a car loan or a mortgage loan, who sets the payments in the schedule? Do you or the bank? The bank, right? So you don't control the cash flow. You have to make payments based on those terms. And sometimes it can be a long, difficult process to get approved. You don't just get to walk in and say, I'd like a loan, right? We could only wish that was the case. Many times the interest costs can be excessively high. They can compound, they can change if you miss a payment. You can even get declined. You may not get access to that collateral. It's tied to your credit report, and so if you have issues with credit, sometimes that can completely limit or eliminate the options you might have. So there's some downsides to traditional debt. Now, in the perpetual wealth financing strategy, you get that benefit of the use of other people's money, but you don't have any of those downsides. You control the cash flow. You set the payments. You decide how and when things get paid back and how the cash flow is managed. And it's not tied to credit. There is no approval process. It's basically like using your cash. So again, remember that principle of keeping you in the center of those two things, profit and control. We want you in the center of profit and control. So you have all the control of cash and all the profit and benefit of using other people's money, letting yours compound uninterrupted for the rest of your life. And if you do it right, you can create generational tax-free wealth this way, which is what the wealthy do. They create wealth that can never be taxed again. So believe it or not, the best financial product on the market to facilitate the perpetual wealth financing process is a properly designed life insurance policy. Now, it's not just any type of life insurance. It's a very specific type of life insurance with the most competitive carriers, designed the right way. So you can't go out and necessarily just buy an off-the-shelf type of product that will do this. It has to be designed this way. But life insurance, done right, is the best tool for doing what you just saw, perpetual wealth financing, whether it's for your company or for your own family. So that is perpetual wealth financing in a nutshell. Obviously, there's a lot of details that we didn't have time to cover in the video as to the specific products and design and how to actually implement this strategy. But that's for another video, another time. So we'd love to hear, as usual, we'd love to hear your feedback in the comment section below. Please leave us your questions, comments, things you'd like to hear more about for future videos. And we'll do our very best to get to those and respond as quickly as we can and engage with you and help you. And of course, you can always feel free to head over to VantageInsuranceSolutions.com. You'll find more information there and other ways to get in touch with us. All right, so again, thank you for your time, and we look forward to seeing you on the next video.